Do you know who mentored Warren Buffett, the world's most successful investor and the father of value investing? It was Benjamin Graham, the man who shaped Buffett's investing philosophy and helped him become one of the wealthiest investors in history. His book, The Intelligent Investor, is a timeless masterpiece that has transformed the way the world thinks about investing. With 640 pages spread across 20 chapters, this book lays the foundation for smart, strategic, and risk-aware investing. But let's be honest, trading. It all takes time. That's why we've distilled its most powerful lessons into a 55-minute video covering all 20 chapters, breaking down key insights with simple, real-world examples. So, whether you're a beginner or an experienced investor looking to refine your strategy, stick around as we unpack the must-know principles of the intelligent investor. Let's dive in, starting with Chapter 1. Chapter 1. Investment versus speculation. Investing means buying something, like a lemonade stand. After researching its profitability and potential for steady returns, think of it as planting a tree and waiting for it to grow fruit. Speculating, on the other hand, is like buying the stand just because everyone else is, hoping to sell it quickly for a profit, more like gambling. Benjamin Graham explains that investors analyze stocks for safety and adequate returns, while speculators chase quick gains without thorough research. For example, buying Apple stock because you believe in its long-term growth is investing, but buying it just because its price rose yesterday is speculating. Graham also introduces two types of investors: defensive investors, who avoid risk and stick to safe, well-established companies like Coca-Cola, and enterprising investors, who take on more risk by researching undervalued stocks or startups. The key takeaway: be an investor focused on long-term growth, not short-term bets. Chapter 2. The Investor and Inflation. Inflation is like the slow thief that steals your money's value over time. Imagine you have $100 today, and a year from now, you might need $105 to buy the same things. That's because prices go up gradually as inflation occurs. For an investor, inflation can eat away at the returns on their investments, so it's essential to consider it when making financial decisions. Benjamin Graham explains that inflation affects both savings and investments. If your money is just sitting in a savings account earning low interest, inflation might cause it to lose value, leaving you with less purchasing power in the future. That's why investing in assets like stocks, bonds, or real estate is often a better way to preserve and grow wealth over time. For example, if you invest in a company like Johnson & Johnson, which has been around for decades, its profits can rise with inflation, helping your investment keep up with the increased cost of living. But if you're just keeping your money under the mattress or in low-interest accounts, inflation will slowly reduce its value. Graham also talks about the importance of real returns, the actual profit you make after accounting for inflation. If your investments are growing at a rate of 5%, but inflation is 3%, your real return is only 2%. It's not just about making money. It's about making sure your money grows faster than inflation. So, how can investors protect themselves from inflation? One way is by investing in things like stocks and bonds that historically tend to beat inflation over the long run. Diversifying your portfolio or spreading your investments across different types of assets also helps keep your wealth growing even when inflation makes things more expensive. The key takeaway? Always think about how inflation will affect your investments. To really build wealth, focus on investments that grow faster than the rising costs of everyday life. Chapter 3. A Century of Stock Market History. The level of stock market prices in early 1972. Stock market prices can often seem unpredictable, but when you zoom out and look at them over long periods, patterns begin to emerge. Imagine looking at the stock market like a long roller coaster ride. There are ups and downs, but over time, the trend tends to go higher. In this chapter, Benjamin Graham takes us on a journey through stock market history, with a focus on the level of stock prices in early 1972. By 1972, the stock market had experienced significant growth since the Great Depression in the 1930s. The market had recovered from its lows, and many people were feeling optimistic about the future. However, Graham cautions that stock prices, even in times of growth, can sometimes get ahead of themselves. In other words, just because the market is doing well doesn't always mean it's priced fairly. In early 1972, stock prices were higher than ever before, and many people were buying stocks with the belief that the market would continue to climb. But Graham reminds investors to be cautious. Stock prices may have been riding high, but that didn't necessarily mean they were a good value. He emphasizes that investors should always assess the real value of a stock, not just the excitement of the market's current performance. The lesson Graham shares from looking at stock market history is that prices can become detached from the underlying value of businesses. While stock prices may seem high in the short term, it's important to ask if the prices reflect the true worth of the company. Investors should be careful not to chase prices based solely on optimism or market trends. By looking at a century of stock market history, Graham shows that even when stock prices are high, it's not a guarantee that they will continue to rise. History has shown that markets can go through periods of boom and bust, and prices can become inflated. So, the key takeaway is that understanding the true value of a company, rather than just following the crowd, is the best approach for long-term success. Chapter 4. General Portfolio Policy. The Defensive Investor. When it comes to investing, not everyone wants to take big risks. Some people prefer to play it safe, aiming for steady, reliable returns rather than chasing after quick profits. This is where the concept of the defensive investor comes into play. A defensive investor is someone who is more concerned with protecting their capital and avoiding losses than with seeking out the highest returns. Imagine you're driving on a road while some people might zoom ahead. Eager for speed, the defensive driver sticks to the speed limit, focusing on safe, cautious progress. Benjamin Graham advises defensive investors to follow a simple and disciplined approach to investing. Instead of trying to pick individual stocks or speculate on market movements, defensive investors should focus on broad, low-risk investments. This often means investing in a mix of stocks and bonds to balance the portfolio. Graham suggests that a defensive investor should have around 25 to 75% of their portfolio in stocks, with the rest in bonds, depending on their risk tolerance. For the stock portion of their portfolio, defensive investors should stick to well-established, large companies with a solid track record. Think of companies like Coca-Cola or Procter & Gamble companies that have been around for a long time and are likely to continue providing steady returns over time. Graham also recommends that defensive investors avoid the temptation of trying to time the market or predict short-term fluctuations. Instead, they should focus on long-term, stable growth. The goal isn't to hit home runs, but to protect your money and let it grow steadily over time. The key takeaway for the defensive investor: keep it simple. Invest in diversified, low-risk assets and focus on steady, long-term growth rather than chasing the latest trends or speculating on the next big thing. By following this strategy, defensive investors can minimize risk and still see consistent returns. Chapter 5. The Defensive Investor and Common Stocks. When it comes to investing, the defensive investor is often more cautious with their approach to stocks. While stocks can offer the potential for higher returns, they also come with more risk. The defensive investor, however, can still take advantage of stocks, but with a focus on stability and minimizing risk. Benjamin Graham explains that for the defensive investor, the key is to avoid speculative stocks and stick to high-quality, established companies. These are companies that have been around for a long time, with a proven history of steady performance. Think of companies like Johnson & Johnson, Procter & Gamble, or other major well-established corporations. Instead of trying to pick the next big thing or the hottest stock on the market, defensive investors should focus on companies that have demonstrated consistent earnings, strong financial health, and a good track record of paying dividends. These stocks are less likely to have dramatic swings in price, making them safer for the long-term investor. Graham suggests that defensive investors should aim for a diversified portfolio, holding a mix of stocks from different industries. This helps spread the risk and reduces the impact of any individual stock's poor performance on the overall portfolio. By diversifying, defensive investors can help protect themselves against downturns in specific sectors or companies. Additionally, Graham recommends that defensive investors use a simple strategy when it comes to buying stocks. Buy in a way that ensures you don't overpay. He emphasizes the importance of considering the price-to-earnings (P/E) ratio and other fundamental metrics to assess whether a stock is priced fairly. The key takeaway for defensive investors when it comes to common stocks: stick to high-quality, well-established companies with a long track record of steady performance. Diversify your portfolio to spread risk and avoid overpaying for stocks. By following these principles, defensive investors can benefit from the growth potential of stocks while keeping their risk level low. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. When it comes to the enterprising investor, they are ready to take on more risk in order to achieve higher returns. However, even the enterprising investor must be strategic in how they approach their investments, and this chapter focuses on a negative approach to portfolio policy. This means minimizing risk and avoiding certain pitfalls in order to maximize the potential for gain. Benjamin Graham explains that the negative approach involves being cautious about which investments to avoid. The enterprising investor doesn't need to take on excessive risk or dive into speculative investments to achieve solid returns. Instead, they focus on identifying and avoiding pitfalls, like overpriced stocks or volatile markets that could lead to major losses. The first key area of focus in this approach is avoiding highly speculative stocks. Graham stresses that the enterprising investor must resist the temptation to invest in stocks that are driven by hype or speculative frenzy. These are often stocks that don't have strong fundamentals, but rather are being bought up because of market sentiment or trends. In other words, the enterprising investor should avoid hot stocks that could easily go cold. Next, Graham recommends avoiding companies that have unclear or poor financial health. The enterprising investor should look for companies with solid financials, low debt, and a track record of reliable earnings. It's also important to steer clear of businesses that may be facing financial difficulties or industry challenges that could affect their stability. Another part of the negative approach is avoiding overly complex or risky investments. Some investments, like certain types of derivatives or leverage strategies, can introduce significant uncertainty into the portfolio. While these may offer the potential for large returns, they can also lead to large losses. Enterprising investors should exercise caution and avoid investments that they don't fully understand or that introduce excessive risk to their portfolio. Finally, Graham advises enterprising investors to avoid putting all their money into one basket. Diversification remains a key principle, even for those who are willing to take on more risk. A well-diversified portfolio helps minimize the potential damage if one investment goes wrong and ensures that the overall risk is spread out. The takeaway from this negative approach is that the enterprising investor should focus on avoiding poor investments and risk-laden strategies. They don't need to chase high-risk, high-reward investments, but should carefully select investments with strong fundamentals, avoid speculation, and make sure their portfolio is diversified. By avoiding common mistakes and focusing on high-quality opportunities, enterprising investors can achieve solid returns while managing risk. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. While the negative approach helps enterprising investors avoid risky investments, the positive side focuses on the proactive steps they can take to achieve strong returns. This chapter outlines how enterprising investors can actively pursue opportunities, research potential investments, and make decisions that maximize their chances of success. Benjamin Graham emphasizes that the enterprising investor's goal is to achieve superior returns by carefully selecting investments that offer value, unlike defensive investors who stick to safe established companies. The enterprising investor looks for opportunities where they can outperform the market by choosing stocks that are undervalued or have strong growth potential. The first step in the positive approach is identifying undervalued stocks. These are stocks that, for one reason or another, are priced lower than their intrinsic value, meaning they offer a bargain for the investor. These companies may be temporarily out of favor, or the market may have overlooked them. The key for the enterprising investor is to perform in-depth research, analyze financials, and determine whether these stocks present a solid investment opportunity. Next, Graham advises enterprising investors to consider special situations opportunities that arise from corporate actions such as mergers, acquisitions, or restructurings. These events can create value for shareholders, and savvy investors can take advantage of them. However, this requires a deep understanding of the market and the specifics of the situation, which is why the enterprising investor must be diligent in their research and approach. Graham also highlights the importance of being patient and having a long-term mindset. While enterprising investors are more actively involved in seeking opportunities, They must still be patient and wait for the right moment to make their move. Timing is critical, and making rash decisions without proper analysis can lead to poor outcomes. Another key element of the positive approach is focusing on high-quality investments. The enterprising investor should not settle for just any undervalued stock. Instead, they should seek out companies with strong management, a proven track record, and potential for future growth. It's about finding the diamonds in the rough stocks that not only offer value, but also have the potential for long-term success. Graham further emphasizes the importance of diversification in this approach, although not to the same extent as the defensive investor. Enterprising investors may take on more concentrated positions in their best ideas, but they should still spread their investments across a range of opportunities to minimize risk. In summary, the positive approach for enterprising investors is about proactively seeking value. By focusing on undervalued stocks, special situations, and high-quality investments, and by applying thorough research and patience, the enterprising investor can build a portfolio that has the potential to outperform the market. This approach requires skill, discipline, and a keen understanding of both the market and individual investments. Chapter 8. The Investor and Market Fluctuations. The Investor and Market Fluctuations focuses on how market fluctuations, short-term price changes in stocks and other securities can affect investors and how they should respond to these fluctuations. Key points in the chapter include understanding market volatility. Market fluctuations are a natural part of investing. Stock prices move up and down due to various factors like market sentiment, economic conditions, and news. Investors must recognize that short-term price movements don't necessarily reflect the true value of a security. Investor psychology. Graham emphasizes the importance of investor psychology in responding to market fluctuations. Emotional reactions like fear and greed can drive investors to make impulsive decisions, such as selling in a panic during a downturn or buying based on excitement during a rally. The Mr. Market analogy. Graham uses the analogy of Mr. Market to explain market fluctuations. Mr. Market is a fictional character who offers to buy or sell stocks at different prices every day, sometimes irrationally high or low. The key takeaway is that investors should not be swayed by Mr. Market's emotions, but instead focus on the intrinsic value of stocks and make decisions based on sound analysis. Long-term investment mindset. Graham advises investors to maintain a long-term perspective where they focus on the underlying value of their investments rather than short-term market fluctuations. Successful investing involves taking advantage of market downturns to buy undervalued stocks and avoiding overreaction to market rallies. Patience and discipline. To navigate market fluctuations effectively, investors need patience and discipline. By sticking to a consistent investment strategy, maintaining a long-term outlook, and avoiding impulsive decisions based on short-term volatility, investors can reduce the impact of market fluctuations on their portfolios. In summary, Chapter 8 stresses the importance of remaining rational, patient, and disciplined during periods of market volatility, focusing on the long-term value of investments rather than reacting to the short-term emotional swings of the market. Chapter 9. Investing in investment funds. Investment funds, such as mutual funds and index funds, provide an easy way for investors to diversify without selecting individual stocks. Benjamin Graham discusses the benefits and drawbacks of these funds and offers guidance on making smart choices. Actively managed funds. Actively managed funds are run by professional managers who aim to outperform the market. However, they come with higher fees and may not consistently deliver superior returns. Graham advises carefully evaluating their long-term performance and costs before investing. Index funds. Index funds, on the other hand, track a market index like the S&P 500, aiming to replicate its performance rather than beat it. These funds are low cost and have historically provided solid returns, making them a good option for defensive investors seeking broad market exposure. Graham stresses that the key to investing in funds is understanding fees, expenses, and tax implications. High fees can erode returns, so it's important to choose funds with low costs that align with your goals. Diversification and risk. Funds offer diversification by pooling investors' money, reducing the risk of a single investment. However, too much diversification can dilute returns, so it's important to find a balance that reduces risk without sacrificing potential gains. Choosing the right fund. When choosing a fund, consider its objective, fees, past performance, and the manager's expertise. Regularly review your investments to ensure they align with your financial goals. The bottom line. Investing in funds can be an effective way to diversify and access a range of securities. Index funds or low-cost mutual funds are often the best choice for most investors, while those willing to take on more risk may explore actively managed funds. The key is to stay informed, keep costs low, and invest for the long term. Chapter 10. The Investor and His Advisors. Benjamin Graham highlights the importance of selecting the right financial advisor to help navigate investments. While advisors can provide valuable guidance, investors must stay involved and understand their financial decisions. Types of advisors. Advisors can range from stockbrokers to wealth managers. Stockbrokers typically offer transactions and may give advice, but their main focus is often on commissions. Wealth managers offer comprehensive services, such as planning and portfolio management, and are usually compensated by fees or a percentage of assets under management. Advisor selection. Graham stresses the importance of finding an advisor who is trustworthy and whose interests align with yours. It's crucial to ensure that advisors are compensated based on performance, not commissions, as this aligns their incentives with yours. The investor's role. Even with a trusted advisor, the investor must remain actively engaged in managing their investments. This includes understanding their portfolio and investment strategies and reviewing their performance regularly. Blindly trusting advisors can lead to unnecessary risks. Beware of conflicts of interest. Many financial advisors may have conflicts of interest, such as recommending products with high commissions. Graham warns investors to be cautious of these potential biases and to always question the motivations behind advice. The bottom line. While advisors can provide valuable expertise, it's important to choose one who is transparent, objective, and fee-based. Investors should remain informed and involved in their investment decisions, ensuring their interests are always a priority. Chapter 11. Security Analysis for the Lay Investor. General Approach. In this chapter, Benjamin Graham introduces security analysis as a way for individual investors to evaluate stocks and bonds. Graham stresses that security analysis doesn't require expert-level knowledge, but can be approached methodically by any lay investor willing to research and analyze. The role of security analysis. Security analysis involves assessing a company's financial health, growth potential, and the risks associated with its securities, stocks, or bonds. The goal is to determine whether a security is fairly priced, undervalued, or overpriced, and to make investment decisions accordingly. Two key approaches. Graham outlines two main approaches to analyzing securities. 1. Top-down approach. This involves analyzing the economy and industry trends before narrowing down to specific companies or securities. 2. Bottom-up approach. This approach focuses directly on analyzing individual companies, starting with their financial statements and business performance. Quantitative and qualitative factors. For the lay investor, Graham advises focusing on both quantitative factors like earnings, book value, and debt ratios, and qualitative aspects like management quality and competitive position. A thorough examination of both factors helps determine the intrinsic value of a security. Margin of safety. A key concept in Graham's approach is the margin of safety, which means buying securities at a price lower than their intrinsic value. This protects investors from unforeseen risks and market volatility. Avoiding speculation. Graham warns against speculative approaches that focus on price trends or market hype. Instead, investors should focus on fundamental analysis, ensuring their investments are based on sound financial data rather than short-term price movements. The bottom line. Security analysis is accessible to individual investors who take the time to research. By combining quantitative and qualitative analysis, focusing on intrinsic value, and ensuring a margin of safety, lay investors can make informed, long-term investment decisions. Chapter 12. Things to consider about per-share earnings. In this chapter, Benjamin Graham discusses the importance of per-share earnings, EPS, and the potential pitfalls investors should be aware of when evaluating a company's financial health. While EPS is a commonly used metric, Graham emphasizes that it is not always a reliable indicator of a company's true value. Understanding per-share earnings. EPS represents the portion of a company's profit allocated to each outstanding share of stock. It is often used by investors to gauge a company's profitability and compare it with others in the same industry. Potential misleading factors. Graham highlights that EPS can be manipulated or influenced by several factors, such as accounting methods. Different accounting techniques can affect reported earnings, making it important to look beyond just the numbers. One-time events. Non-recurring items, like asset sales or tax benefits, may inflate EPS temporarily, which doesn't reflect the company's ongoing earnings power. Share buybacks. Companies that repurchase shares may boost EPS without improving their actual financial performance, creating a misleading sense of profitability. The importance of consistency. Investors should pay attention to the consistency and sustainability of earnings over time, rather than relying on short-term fluctuations. A company with erratic earnings may be more risky than one with steady, predictable profits. Earnings adjustments. Graham advises looking beyond the raw EPS figure and considering adjusted earnings, which account for unusual items or potential distortions. Adjusted EPS gives a clearer picture of the company's long-term earning potential. Margin of safety. To protect against misleading EPS, Graham advises a focus on a company's intrinsic value and a margin of safety. This ensures that even if EPS numbers are unreliable, the investor is still purchasing a security with significant room for error. Conclusion. While per-share earnings are an important measure, they should be used cautiously. Investors should look beyond the headline figure, consider the quality and sustainability of earnings, and be wary of accounting manipulations. Only with a careful analysis can investors make well-informed decisions. Chapter 13. A comparison of 4 listed companies. In this chapter, Benjamin Graham provides a comparative analysis of 4 publicly traded companies to highlight key principles for evaluating stocks. The goal is to showcase how investors should use fundamental analysis to assess the financial health and potential of a company and make more informed investment decisions. Company selection. Graham selects 4 companies from different industries to compare based on several financial metrics, including earnings stability, dividend history, and financial strength. Earnings and stability. The first metric Graham emphasizes is the stability of earnings over time. Companies with steady earnings are generally less risky and more attractive to conservative investors. Those with volatile earnings, on the other hand, may present higher potential rewards, but come with increased risk. Dividend history. Graham also looks at the company's dividend-paying histories. A consistent track record of paying dividends, especially during economic downturns, is a sign of a financially stable company. Companies that cut or eliminate dividends during tough times may be in financial trouble. Financial strength. Another crucial aspect is financial strength, including the company's debt-to-equity ratio. Companies with excessive debt may face trouble during economic downturns, while those with lower debt are in a better position to weather market volatility. Valuation. Graham stresses the importance of purchasing stocks at reasonable prices. He advises investors to focus on intrinsic value, which includes factors like earnings power, assets, and growth potential. Investors should compare a company's stock price to its underlying value to determine if it's overvalued or undervalued. Key takeaways. Stable earnings and consistent dividends are indicators of a solid investment. Financial strength, especially low debt, offers greater stability and less risk. Proper valuation is essential for avoiding overpaying for a stock. Conclusion. By comparing these 4 companies, Graham illustrates how to evaluate stocks beyond just the price. Investors should look at a variety of financial factors to make sound investment decisions. The companies that display financial stability, consistent earnings, and reasonable valuation are generally the best candidates for investment. Chapter 14. Stock selection for the defensive investor. In this chapter, Benjamin Graham provides guidelines for the defensive investor, those who prefer a more conservative approach to investing with a focus on safety and steady returns. Key principles. Diversification. The defensive investor should spread investments across a variety of stocks to reduce risk. A well-diversified portfolio can help protect against the poor performance of individual stocks. Focus on large, established companies. Graham recommends investing in large, financially stable companies with a long history of stable earnings and dividends. These companies are less volatile and more likely to weather market downturn. Dividend-paying stocks. Stocks that consistently pay dividends are essential for the defensive investor. These dividends provide a steady income stream, even during market fluctuations, and indicate financial strength. Financial strength and stability. The defensive investor should prioritize companies with a strong balance sheet, low debt, and solid profit margins. Financially strong companies are less likely to face major risks. Price to earnings, P/E ratio. Graham suggests that defensive investors should avoid overpaying for stocks. A reasonable P/E ratio helps ensure that they aren't buying into overvalued companies. A P/E ratio that is too high may indicate a stock is overpriced. Use of screening criteria. Graham proposes specific financial criteria for selecting stocks, including consistent earnings growth, low debt-to-equity ratio, and a reasonable P/E ratio. Stocks that meet these criteria are considered more suitable for defensive investors. Key takeaways. Diversification reduces risk and protects against market volatility. Invest in large, stable companies with consistent earnings and dividends. Focus on financial strength, low debt, and a reasonable price-to-earnings ratio. Avoid overpriced stocks by paying attention to valuation metrics. Conclusion. For the defensive investor, stock selection should focus on safety, stability, and consistency. By investing in financially strong, well-established companies with a history of steady earnings and dividends, the defensive investor can build a secure portfolio that offers steady returns with lower risk. Chapter 15. Stock Selection for the Enterprising Investor. This chapter focuses on the enterprising investor who is willing to take on more risk in exchange for the potential of higher returns. Graham offers a more active and aggressive approach to stock selection compared to the defensive investor. Key principles. Search for undervalued stocks. The enterprising investor should seek stocks that are undervalued by the market. These stocks may be temporarily neglected or mispriced, offering a chance for profit when their true value is realized. In-depth research. Active investors should be ready to invest time and effort in researching stocks. This includes analyzing financial statements, understanding company prospects, and evaluating industry conditions. A thorough analysis helps identify hidden opportunities, small companies, and special situations. The enterprising investor can consider investing in smaller companies, turnaround situations, or special situations, e.g., mergers, spin-offs, or distressed assets that offer growth potential but come with higher risk. Margin of safety. Even for the enterprising investor, maintaining a margin of safety is critical. This means buying stocks at prices significantly below their intrinsic value, reducing the risk of loss if the investment does not perform as expected, avoiding overpaying. While searching for undervalued stocks, it is important not to overpay for them. A good investment is one where the potential reward outweighs the risk, which means buying when the stock price offers an attractive margin of safety. Flexibility and patience. Enterprising investors need flexibility and patience to react to market changes. They should be able to seize opportunities when they arise, but also hold investments long enough to allow their value to appreciate. Key takeaways. Enterprising investors seek undervalued stocks through thorough research. Special situations, such as turnarounds and mergers, offer opportunities. The margin of safety remains essential to minimize risk. Flexibility and patience are key to maximizing long-term gains. Conclusion. Stock selection for the enterprising investor involves more effort and research, but offers higher reward potential. By focusing on undervalued stocks and special situations, and by maintaining a margin of safety, the enterprising investor can achieve substantial returns with careful planning and analysis. Chapter 16. Convertible Issues and Warrants. This chapter explores convertible securities, bonds or preferred stock that can be converted into common stock, and warrants, options that allow the purchase of stock at a set price. These instruments can provide opportunities for investors, but they also come with specific risks. Key concepts: convertible bonds and preferred stock. Convertible bonds allow investors to exchange their bonds for a predetermined number of shares in the issuing company. These offer regular interest payments, but also the potential for capital gains if the stock price rises. The appeal lies in the ability to convert into stock if the company's performance improves, allowing for upside potential while still providing downside protection through fixed income. Warrants. Warrants give investors the right to buy stock at a specified price, the exercise price, within a certain time frame. Like options, warrants can be valuable if the stock price increases significantly above the exercise price. However, they come with the risk of losing their value if the stock price does not rise above the exercise price within the given period. Risks and considerations. Both convertibles and warrants have risks related to the performance of the underlying stock. If the company's stock price declines, the value of these securities can also fall, sometimes to zero. Additionally, convertibles and warrants can be complicated to analyze, requiring an understanding of both the fixed income and equity components of the security. Investor strategy. Conservative investors may use convertibles for income with the possibility of equity growth, while enterprising investors may use them to capitalize on stock price appreciation. Warrants, on the other hand, are more speculative and suitable for investors willing to take higher risks for potentially larger returns. Convertible securities in the market. Convertibles are often issued by companies that are not strong enough to offer traditional equity financing but still want to attract capital. The convertibility feature can help reduce the interest rate on the bond. They are usually a hybrid between bonds and stocks, offering features of both, and their pricing depends on factors such as interest rates, the company's stock performance, and the time left until conversion. Key takeaways. Convertible securities provide income and potential stock upside, but their value is tied to stock performance. Warrants are a high-risk, high-reward investment dependent on stock price movement. These securities can be useful for enterprising investors, but caution is needed to avoid overestimating their potential. Conclusion. Convertible bonds, preferred stock, and warrants can offer unique opportunities for profit, but they require careful analysis. While they provide the chance for upside, they also carry risks, especially if the underlying company's stock doesn't perform well. These securities can be a valuable addition for investors who understand their complexities and are willing to take on the associated risks. Chapter 17. 4. Extremely instructive case histories and more. This chapter examines 4 case studies that provide valuable insights into successful investing strategies, showcasing the practical application of principles discussed in earlier chapters. These examples demonstrate how to approach stocks, bonds, and other securities through careful analysis. Key concepts. Case Study 1. The Coca-Cola Company. Coca-Cola is a textbook example of a solid, well-established company that provides steady returns over time. The stock's long-term growth is fueled by its dominant market position, strong brand, and consistent profitability. This case highlights the importance of investing in companies with a clear competitive advantage and long-term stability. Case Study 2. The X Corporation. The X Corporation's performance highlights the risk of investing in companies with uncertain futures, particularly those with volatile earnings and high debt levels. While growth opportunities may exist, the lack of stability and heavy reliance on external factors makes the company a less attractive choice for defensive investors. Case Study 3. A speculative approach to stock picking. This case demonstrates the perils of speculation, where investors focus on short-term trends and rely on market momentum rather than sound financial analysis. The case reveals how quickly speculative stocks can lose value when market sentiment changes, underscoring the importance of avoiding short-term speculation for long-term investors. Case Study 4. Bonds and preferred stocks in action. This study focuses on bonds and preferred stocks, emphasizing their role in a well-balanced portfolio. Bonds offer security and income, while preferred stocks provide a hybrid investment with equity upside potential. Both can be effective tools for conservative investors seeking steady returns with less volatility than common stocks. Additional insights. The importance of diversification. These case studies reinforce the value of diversification in building a robust portfolio. Relying too heavily on a single company or sector can lead to significant risks. A diversified portfolio reduces the impact of individual stock volatility and improves long-term stability. Investor psychology and market timing. The chapter also explores the psychological factors that influence investment decisions, such as fear of missing out, FOMO, or panic selling during market declines. It emphasizes the importance of sticking to a disciplined investment strategy and avoiding emotional decisions based on short-term market movements. Key takeaways. Successful investing requires a careful analysis of company fundamentals, market conditions, and individual investment goals. The case studies demonstrate the practical application of key investment principles, such as focusing on well-established companies and avoiding speculative ventures. Diversification, patience, and discipline are essential traits for long-term investment success. Conclusion. The case histories illustrate the importance of following a logical, well-researched investment approach and avoiding the allure of quick gains from speculative ventures. They reinforce the idea that investing for the long term in high-quality companies, while maintaining a diversified portfolio, leads to more consistent and reliable returns. Chapter 18. A comparison of 8 pairs of companies. In this chapter, 8 pairs of companies are compared to demonstrate how different business strategies and financial characteristics affect their potential for investment. By contrasting various aspects, this analysis teaches investors how to identify opportunities and risks in different types of companies. Key concepts. Pair 1. High potential growth versus stability. One company is high risk, high reward, with a focus on rapid growth and expansion, while the other is a stable company with slow but steady growth. This comparison shows that high-growth companies can lead to significant profits, but they come with greater volatility, while stable companies offer safety but may not offer significant returns. Pair 2. Conservative versus aggressive capital structure. One company is financially conservative, with low debt and a focus on sustainability, while the other is more aggressive, using debt to fund expansion and growth. Companies with low debt are generally less risky, whereas those that use leverage can generate higher returns but involve more risk, particularly in uncertain markets. Pair 3. Traditional versus disruptive business models. One company follows traditional business methods, while the other is a market disruptor aiming for innovation. The traditional company tends to offer steady returns, whereas the disruptive company may offer substantial growth opportunities, but also faces the challenges of market adoption. Pair 4. Domestic versus international reach. One company operates within its local market, while the other has a broad international presence. International companies tend to benefit from global growth, but also face risks such as currency fluctuations and political instability, unlike domestic companies that are more insulated from these external factors. Pair 5. High dividends versus growth focus. One company offers high dividends as a regular source of income, while the other reinvests its earnings to fund growth, offering little to no dividends. Dividend-paying stocks attract investors looking for steady income, while growth-focused stocks may appeal to those seeking capital appreciation over time. Pair 6. Established companies versus startups. One company is an established, well-known market leader, while the other is a newer startup with innovative potential. Established companies offer security and reliability, whereas startups have higher growth potential but come with a higher risk of failure. Pair 7. Profitable versus loss-making firms. One company is profitable with consistent earnings, while the other has struggled with losses. Profitable companies are typically more stable investments, while loss-making firms present higher risks but may offer large returns if they manage to turn things around. Pair 8. Market leaders versus undervalued stocks. One company is a dominant market leader, while the other is an undervalued company with potential for growth if it gains market share. Market leaders tend to be safe investments, but undervalued stocks can offer significant returns if they perform well or become more widely recognized. Key takeaways. This comparison of companies highlights the importance of evaluating growth potential, financial structure, and market positioning. Investors must carefully balance risk and return when selecting investments, considering factors like debt levels, dividend policies, and business models. Diversification is crucial for mitigating risk, as different types of companies serve different roles in a well-rounded portfolio. Conclusion. The chapter stresses the importance of a comprehensive approach to company analysis. By comparing companies in different categories, investors can make more informed decisions, recognizing that no single type of company is ideal for all investors. A well-researched investment strategy should reflect an understanding of both risks and rewards. Chapter 19. Shareholders and managements. Dividend policy. This chapter examines the relationship between shareholders and company management, with a focus on how dividend policies impact investment decisions and overall company strategy. It outlines key concepts of dividend policies and their implications for both companies and their investors. Key concepts: dividend versus retained earnings. Companies have two primary ways to allocate profits: paying dividends to shareholders or retaining earnings to reinvest in the business. A dividend policy is a way for companies to distribute profits to shareholders, while retained earnings are reinvested for growth, acquisitions, or debt reduction. The decision to pay dividends versus retaining earnings depends on the company's strategy and growth prospects. Impact of dividend policy on company valuation. Some investors favor dividends because they provide a steady stream of income, while others may prefer growth companies that reinvest earnings. A high dividend payout can signal financial health and stability, appealing to conservative investors, while a low or no dividend payout might attract those seeking growth potential. Types of dividend policies. Stable dividend policy. The company commits to paying a consistent and predictable dividend over time, regardless of earnings fluctuations. This is attractive to income-focused investors. Irregular dividend policy. The company pays dividends based on its profits, resulting in variable payments that fluctuate with earnings. This type of policy may be used by growth companies. Residual dividend policy. Dividends are paid out from remaining profits after all profitable investment opportunities are funded, typically resulting in fluctuating dividend payments. Signaling effective dividends. Dividends can serve as a signal of the company's confidence in future earnings. Increasing dividends may suggest positive future growth, while decreasing dividends might indicate financial distress. Management must balance the need to reinvest in the business with the desire to provide returns to shareholders. A sudden change in dividend policy can impact stock prices and investor sentiment. Dividend policy and taxes. Tax considerations also influence dividend policy. In some countries, dividends are taxed more heavily than capital gains, which may lead companies to retain earnings and reinvest instead of paying dividends. Investors in high-tax jurisdictions may prefer stocks with low or no dividends, as they will benefit more from capital gains. Dividend policy and investment preferences. Investors with different risk tolerances may have different preferences regarding dividends. Conservative investors may prefer companies with a stable dividend history, while more aggressive investors may prefer companies that reinvest their earnings for growth. The role of management in dividend decisions. Company management plays a central role in deciding the dividend policy. They must consider factors such as cash flow, future growth opportunities, and the desires of investors. Management's goal is to strike a balance between rewarding shareholders and ensuring sufficient funds for the company's long-term growth. Key takeaways. Dividend policy is a crucial component of a company's overall strategy and directly impacts shareholder value and investor perceptions. The appropriate dividend policy depends on a company's financial health, growth prospects, and investor base. Investors need to understand the tax implications and the company's approach to reinvesting profits when assessing dividend policies. Both stable and irregular dividend policies have their merits, and the choice depends on the company's growth stage and market conditions. Conclusion. The chapter emphasizes the strategic decisions management must make regarding dividends. Shareholders are impacted by these decisions, as they shape their income and the overall financial health of the company. Dividend policies reflect a company's philosophy on balancing shareholder returns and reinvestment for growth, with careful consideration of market conditions, taxation, and investor preferences. Chapter 20. Margin of safety as the central concept of investment. Chapter 20 explores the concept of margin of safety, which is a fundamental principle in value investing. This principle is critical for protecting investors from downside risks and ensuring long-term success in investing. Key concepts. Definition of margin of safety. The margin of safety refers to the difference between the intrinsic value of an investment and its market price. It represents a buffer to protect against errors in judgment or unforeseen events that could affect the investment. A large margin of safety means that the investment is less risky, as it provides a cushion against potential losses. Intrinsic value versus market price. Intrinsic value is the true inherent value of a company or asset, based on fundamentals such as earnings, dividends, and growth potential. Market price is what investors are willing to pay in the market, which can often differ from intrinsic value due to emotions, market trends, or speculation. Importance of margin of safety. The primary purpose of the margin of safety is to minimize the risk of permanent loss. By purchasing assets with a significant margin between the market price and intrinsic value, investors reduce the likelihood of overpaying for an asset. This margin protects investors against mistakes, miscalculations, and market downturns, allowing them to weather volatility. How to calculate margin of safety? The margin of safety can be calculated by subtracting the market price from the intrinsic value and dividing by the intrinsic value. A higher ratio indicates a greater margin of safety. For example, if a stock's intrinsic value is estimated at $100 and it is available for purchase at $80, the margin of safety is 20%. Margin of safety and investment philosophy. The concept is central to the investment philosophy of Benjamin Graham and Warren Buffett. They emphasize buying stocks with a significant margin of safety, which ensures that even if their analysis is flawed, there's enough cushion to protect against losses. This approach prioritizes safety and long-term growth rather than short-term speculative gains. How margin of safety reduces risk. Investing in assets with a significant margin of safety reduces the risk of permanent loss because the investor is purchasing at a price lower than the intrinsic value, which provides an automatic cushion. It is an antidote to speculative investing, which often leads to overpaying for assets and exposes investors to higher risks. The role of conservative estimates. When calculating intrinsic value, it's important to be conservative and avoid overly optimistic assumptions. Overestimating growth or underestimating risks can lead to a small margin of safety and increase the potential for loss. Being cautious ensures that there's a larger cushion in case of unforeseen events or mistakes in valuation. Practical applications. The margin of safety concept applies to all types of investments, from stocks to bonds to real estate. By evaluating the intrinsic value of an asset and comparing it to its market price, investors can determine whether the margin of safety is sufficient to justify the investment. It encourages patience, as investors wait for opportunities where the market price is significantly below intrinsic value. Key takeaways. The margin of safety is a critical principle in value investing that helps reduce risk and prevent permanent loss of capital. Investors should focus on buying assets with a significant cushion between market price and intrinsic value. A large margin of safety is especially important in volatile or uncertain markets, providing protection against unforeseen events. Conservative, well-researched estimates of intrinsic value are essential for ensuring an adequate margin of safety. Conclusion. The margin of safety is the cornerstone of successful long-term investing. By ensuring that investments are made with a sufficient buffer between intrinsic value and market price, investors can minimize risk and avoid losses. This conservative approach allows investors to remain confident in their decisions, even during periods of market instability. Finally, having covered a summary of all 20 chapters, we have now reached the end of this video. As we've journeyed through the world of investing in this book, we've explored timeless principles from Benjamin Graham, uncovering the nuances between investing and speculation, understanding the importance of portfolio management, and delving deep into the concept of margin of safety. Each chapter has equipped you with the tools to make informed, calculated investment decisions, from choosing stocks for defensive investors to navigating the complex world of investment funds and company analysis. Whether you're a defensive investor looking to minimize risk, an enterprising investor seeking opportunities for growth, or someone just starting to learn about the stock market, the insights from this book offer something for everyone. The key takeaway remains clear. Make your decisions based on solid research, a conservative approach, and always ensure a margin of safety to protect your investments. To continue your journey of knowledge and mastery, be sure to stay connected with us. Subscribe to the AI Tools channel for more insightful videos, where we dive deeper into concepts like these and introduce new AI-driven tools that can take your understanding of finance, investing, and beyond to the next level. Stay curious, keep learning, and let the power of informed investing guide you to financial success